What will happen to Donald Trump if Fed cuts rates to rescue his economy? Imagine a moment where Wall Street cheers, the markets surge, and headlines flash. The Federal Reserve cuts rates again. But here's the catch. This isn't just an economic maneuver. It's a political lifeline with Donald Trump standing at the center. If the Fed steps in to rescue an economy under his leadership, does it save his political brand as the self-proclaimed master of growth, or does it expose just how fragile his narrative really is? The stakes aren't just about numbers on a chart. They're about credibility, power, and the battle for the White House. Stay tuned as we break it down right now. The American economy is always at the center of political life, shaping voter behavior, financial markets, and international relations. For any president, the economy is both an opportunity and a risk. For Donald Trump, returning to the White House after years of political turmoil, the economy is not only a measure of his leadership, but also a test of whether his policies can withstand the scrutiny of markets and institutions. Recent economic data has painted a challenging picture. Job creation has slowed dramatically, consumer confidence has fallen, and inflationary pressures remain a persistent concern. At the same time, tariffs and trade conflicts have contributed to price increases in everyday goods, placing additional strain on households. In this context, the Federal Reserve, as the central bank of the United States, faces the question of whether to cut interest rates to provide relief. This analysis explores what would happen if the Federal Reserve does decide to cut rates in order to stabilize the economy under Trump's leadership. We will examine the mechanics of such a policy, the immediate economic consequences, the political implications for Trump himself, and the broader impact on American society. The starting point is the data released by the Bureau of Labor Statistics. According to the transcript, job creation in August was approximately 22,000 jobs. This number fell far below expectations, which were set at around 80,000. To place this in perspective, during the final year of the Biden administration, monthly job creation averaged 170,000. Compounding this problem, revisions to earlier months' numbers revealed negative job growth in June, amounting to a loss of 14,000 jobs. When averaged across a 3-month period, the economy under Trump's renewed administration added only about 22,000 jobs per month. This weak performance has tangible consequences. First, consumer confidence has dropped. Polling shows that voters, including many who supported Trump, now describe the economy as struggling. Second, employers are hesitant to hire. The Federal Reserve's Beige Book, a survey of regional banks, indicated that 7 of 12 districts reported widespread reluctance to expand payrolls. Third, wholesale prices have risen, particularly due to tariffs, which filter down to consumer goods. Fruits, vegetables, and other staples are reportedly up 30 to 40% in price. Taken together, these elements describe an economy experiencing stagnation, higher costs, and diminished optimism. The Federal Reserve, whose primary tools include setting the federal funds rate, now faces pressure to act. The Federal Reserve's mission is twofold: maintain price stability and promote maximum employment. Typically, these objectives are in tension. When inflation is high, the Fed raises interest rates to cool demand. When unemployment rises, it lowers rates to encourage borrowing and investment. As of the September 18th meeting, the federal funds rate stood between 4.25 and 4.5%. For households, this translates into higher costs for mortgages, auto loans, and credit cards. For businesses, it raises the cost of financing expansion and hiring. The pressure on the Fed comes from multiple directions. On the one hand, inflation is still above the 2% target, hovering closer to 4%. On the other hand, weak job creation and falling consumer confidence signal that the labor market may be deteriorating. If the Fed cuts rates, it hopes to stimulate demand by making credit cheaper. This could encourage households to borrow for large purchases and businesses to finance new investments. However, the risk is that cheaper money could reignite inflation. Thus, the Fed faces a balancing act between rescuing growth and avoiding an inflationary spiral. If the Federal Reserve proceeds with a rate cut of 0.5 percentage point, several short-term outcomes are likely. First, consumer borrowing costs would decline. Mortgage rates, currently elevated, might drop modestly, stimulating demand in the housing market. Auto loans and credit card rates would ease slightly, offering relief to households under debt stress. Second, business financing would become more affordable. Manufacturers and retailers could secure loans at lower interest rates, enabling them to expand inventories or invest in equipment. This could generate a modest increase in hiring, particularly in sectors sensitive to credit conditions. Third, financial markets would likely respond positively, at least in the immediate aftermath. Stock indices tend to rise following rate cuts, as investors anticipate stronger corporate earnings supported by cheaper credit. However, these benefits come with trade-offs. If consumer spending rebounds too quickly, demand may outpace supply, leading to renewed inflationary pressures. For a population already frustrated with rising food and energy costs, this would complicate the recovery. The political consequences of a rate cut are complex. On one level, a cut could provide Trump with short-term political relief. If job creation rebounds and consumer sentiment improves, he could claim credit for restoring confidence. Presidents are often judged on the state of the economy, and even modest improvements may shift public perception. On another level, however, the optics are more complicated. Critics would argue that the Fed was forced into cutting rates because of the economic instability generated by Trump's own policies, particularly tariffs and trade conflicts. If inflation accelerates following the cuts, Trump could face accusations of mismanagement that undermined both stability and credibility. In addition, the Federal Reserve is an independent institution. Any perception that it is cutting rates to rescue Trump politically could erode confidence in the central bank's neutrality. Such a perception would invite scrutiny from Congress, financial analysts, and the media, potentially complicating Trump's relationship with the Fed. American history offers several precedents for understanding the risks and opportunities associated with rate cuts during economic downturns. President Herbert Hoover faced the onset of the Great Depression. Despite attempts to stabilize the economy, the perception of inaction and mismanagement contributed to his electoral defeat. President Jimmy Carter struggled with stagflation in the late 1970s. High inflation and weak growth created an environment where rate cuts provided little relief. The political cost was high, and Carter's presidency is often remembered more for economic struggles than for foreign policy achievements. President George H.W. Bush presided over a mild recession in the early 1990s. Although the economy was technically recovering by the time of the 1992 election, the perception of weakness cost him re-election. These cases underscore a consistent lesson. Presidents are judged not only on actual economic performance, but also on public perception. If Trump's economy continues to be associated with instability, a rate cut may not be enough to change the narrative. It is also important to recognize that the Federal Reserve cannot solve all economic problems. Monetary policy is a blunt instrument. It can influence borrowing and lending, but it cannot address structural issues such as tariffs, supply chain disruptions, or declining productivity. If Trump's trade policies continue to raise prices on imports, rate cuts may provide only limited relief. Similarly, if employers remain hesitant to hire due to political uncertainty, lower rates alone may not stimulate job growth. Moreover, repeated rate cuts risk creating financial distortions. Excessive borrowing could lead to asset bubbles, particularly in real estate and equities. If inflation accelerates beyond control, the Fed would be forced to reverse course quickly, potentially triggering a deeper recession. Behind the statistics are real households facing difficult choices. Rising prices for food and fuel force families to cut back on essentials. Parents may reduce grocery purchases, postpone medical care, or delay educational expenses. Seniors on fixed incomes face particular challenges as inflation erodes purchasing power. When consumer confidence falls, the psychological impact extends beyond financial stress. Anxiety about job security and living standards can weaken trust in institutions and leaders. If citizens perceive that economic policy favors the wealthy while neglecting the middle class, social cohesion may fray. In this sense, the Fed's decision to cut rates is not merely a technical matter. It touches the lives of millions of Americans whose day-to-day survival depends on stable prices, secure employment, and affordable credit. Several scenarios can be outlined depending on the interaction between Fed policy and Trump's economic agenda. Scenario 1 is modest recovery. A rate cut succeeds in stabilizing borrowing and spending. Job creation improves slightly, and consumer sentiment begins to recover. In this case, Trump may benefit politically, claiming that his leadership has restored growth. Scenario 2 is inflation resurgence. A rate cut stimulates demand but also pushes prices higher. Inflation remains above 4% and household frustrations deepen. In this scenario, Trump faces mounting criticism for both high prices and weak job creation. Scenario 3 is prolonged stagnation. Rate cuts fail to stimulate meaningful hiring, and employers remain cautious. Job growth stays flat, consumer confidence lingers at low levels, and political pressure intensifies. This outcome risks undermining Trump's credibility heading into future elections. The question of what will happen to Donald Trump if the Federal Reserve cuts rates to rescue his economy has no simple answer. The outcome depends on a delicate balance between monetary policy, political perception, and structural economic conditions. In the short term, Trump may benefit from the appearance of action and potential improvements in consumer sentiment. However, the underlying challenges, weak job creation, tariff-driven price increases, and employer hesitation, cannot be resolved by interest rates alone. History suggests that presidents are judged harshly when the economy falters, regardless of the causes. Unless structural issues are addressed, a rate cut risks being viewed as a temporary patch rather than a solution. For Trump, the stakes are high. Success could bolster his claims of economic stewardship. Failure could reinforce narratives of instability and mismanagement. For the Federal Reserve, the challenge remains to fulfill its mandate while preserving credibility. For American families, the consequences are tangible, affecting the cost of living, job security, and trust in leadership. Ultimately, the story of rate cuts under Trump is not only about economic policy, but also about the intersection of governance, perception, and lived reality. The next months will reveal whether monetary easing provides relief or merely postpones deeper challenges.